We begin with the night when the trains stopped running. The elevators had been silent for hours. Inside the executive boardroom, a single fluorescent tube buzzed above a long mahogany table, illuminating a battlefield of half-smoked cigarettes, cold coffee, unopened envelopes, and financial reports no one dared touch anymore. At the head of the table, the CEO sat motionless. A single sheet of paper trembled in his hand. Not a projection, not a memo, a verdict. Cash on hand, insufficient to meet Monday payroll. Outside, Manhattan glowed with late-night confidence, completely unaware that one of America's most important companies was dying behind closed blinds. Penn Central wasn't just a railroad. It was the industrial bloodstream of the Northeast, hauling coal, steel, grain, automobiles, everything that kept America moving, and now it was out of money. The CFO finally spoke. Are we certain the Treasury Department won't extend the bridge loan? They're done. No more support, not after what they saw in our books. Everyone in the room understood. For years, Penn Central had been living on illusions, hiding losses, rolling debt forward month after month, projecting fictional revenue, paying dividends they could not afford. The facade was gone. A vice president whispered what no one wanted to say. So we file? The CEO didn't answer. He looked down at the beige rotary phone, wired directly to their attorneys. At 11:59, he lifted the receiver. It's time. With those two words, the largest corporate bankruptcy in U.S. history began. Trains would still run for a few days. Workers would still show up. Cargo would still load. But the heart of Penn Central, an American institution, had already stopped beating. Debt, mismanagement, fabricated projections, incentives twisted beyond recognition. The collapse was inevitable the moment the executives began believing their own numbers. This was the summer before my senior year in high school. I had already started investing, placing trades through my broker Jim Detling at the broker F.I. DuPont and Company in South Bend, Indiana, a firm owned by H. Ross Perot. This was long before online trading, long before discount brokers. It was just me, a telephone, and the Standard & Poor's sheets that I could find at my school library, and whatever other research I could scrape together. The money wasn't much, but to me it was everything. Every dollar came from my part-time job at the State Theater, and whatever else a teenager could do to earn a few bucks. And since this was a uniform gift to miner's account, one that my father had control of, he gave my brokers one instruction: do whatever he tells you. It's his money, and this is how he's going to learn. F.I. DuPont itself would later collapse in its own back office scandal, a lesson in fragility I didn't fully appreciate yet. But that summer, Penn Central dominated the headlines, and I remember adults asking, how could a company this big, this essential, this American just fall apart? And that moment taught me something I would see proven over and over again. Even the biggest corporations can rot from within when the incentives are wrong, when truth is buried, when financial engineering replaces financial health. And nowhere is that dynamic more misunderstood or more abused than in the world of stock buybacks. Welcome to Markets Without Spin, the podcast that cuts through financial media noise to examine what's really happening in markets and the global economy. I'm Franz Amundsen. I spent more than 40 years in the investment world. I started professionally in the business in 1985, but I had personally been investing since 1969, before ETFs, before online trading, before financial engineering became a part of everyday corporate life. I lived through the crash of '87, the dot-com mania, the 2000 collapse, the housing bubble, the 2008 crisis, the zero interest rate decade. And across those decades, I watched Wall Street narratives evolve, from the Nifty 50 to the Magnificent Seven and every investing fad in between. I watched incentives mutate, and I watched tactics once considered manipulative gradually become celebrated. And nothing illustrates that shift better than stock buybacks. When I started my career, buybacks were rare and widely considered a form of market manipulation. Today, they're the default method of quote-unquote returning capital, the easiest way to boost earnings per share, the fastest path to executive bonuses. But here's the truth. Stock buybacks do not return money to shareholders. They return money to sellers. If you didn't sell, you didn't get a dime. Dividends put cash in your pocket. Buybacks put hope and hype in your portfolio. But hope is not a strategy. Charlie Munger said it best. People do what they are rewarded for better or worse. When CEO compensation depends on earnings per share growth, they will find a way to grow earnings per share. And the easiest method? Reduce the share count. Even if the business isn't growing, even if cash flow is weakening, even if the company must borrow money to do it. But why do buybacks look smart, even when they're not? Well, large buybacks are always supported by intrinsic value calculations. But intrinsic value is not a number. It's a story wrapped in math. Companies bring in consultants, investment banks, valuation firms, advisory shops. But these consultants aren't hired to disagree, they're hired to validate. They create an appearance of objectivity, provide legal cover, support management's assumptions, and they must avoid alienating future business. Spreadsheets give an illusion of scientific precision. Adjust a discount rate, and valuation jumps or collapses. Change a margin assumption, and the model sings a different tune. The spreadsheet always obeys its master. And the most dangerous buyback of all, debt finance buybacks. Here's where things become destructive. Throughout my career, I've watched companies borrow billions, weaken their balance sheet, drain free cash flow, and use that borrowed money to buy their own stock. This isn't returning capital, it's a leveraged bet on the company's own stock price. If the stock rises, great. If it falls, the debt remains, the interest remains, the damage remains. Some companies never recover. Which brings us to the most consequential case study in modern corporate history. The ultimate example, General Electric. To understand the magnitude of what happened to General Electric, you have to remember where it came from. GE wasn't just a successful corporation. It wasn't just a blue chip. It was a company born from genius. It traces its roots back to Thomas Edison, one of the most influential inventors in history. A man whose work literally electrified the modern world. In 1892, Edison's company merged with Thomson Houston Electric to form what became General Electric, a newly combined industrial powerhouse built on innovation, engineering brilliance, and the promise of the American century. An original Dow 30 stock, a pristine AAA credit rating, the highest possible, almost as safe as U.S. Treasuries, a corporate Mount Everest. But by 2010, GE had shifted from building engines and turbines to building models and narratives. They leaned heavily on financial engineering, accounting maneuvers, short-term borrowings, and some of the most aggressive stock buybacks in corporate history. Between 2010 and 2017, GE spent over $40 billion repurchasing its own stock, the equivalent of $50 to $55 billion in today's dollars. And they bought those shares at $25, $28, $30, and even $32 a share, because their internal models said the stock was undervalued, and their consultants stamped those reports. Management repeated the story confidently, endlessly. But the truth always wins. By late 2018, GE stock traded for $6 per share, a collapse so steep it stunned Wall Street, a fall from the mountaintop to the canyon floor. The money used for buybacks wasn't returned to shareholders, it was vaporized. And the debt GE took on to fund those buybacks, that debt remained. Heavy, immovable, crushing. The consequences were brutal. The dividend, once sacred, cut to 1 penny. Tens of thousands of layoffs, massive write-downs, entire business units sold off just to stay alive, and after more than a century, its removal from the Dow Jones Industrial Average. But here's the part that still shocks people. As GE's financial engineering spiraled, its legendary AAA credit rating didn't just slip, it collapsed, falling all the way down to BBB, one step above junk. GE didn't fall because it paid dividends. It fell because it used borrowed money to buy back its stock at fantasy valuations, because the model said what the executives wanted them to say, and because the incentives rewarded short-term optics over long-term health. Just like Penn Central, GE ignored the warning signs. And like Penn Central, the cost of that blindness was catastrophic. This wraps up the pilot episode of Markets Without Spin. In our first full episode, episode 1, we'll dive into the engine behind the modern buyback behavior, executive compensation. Why CEOs chase earnings per share growth even when fundamentals are deteriorating. Why the incentive structure rewards short-term optics over long-term strength. And why the system works exactly as designed, even when it destroys value. New episodes will be released every 2 weeks. So if you want to follow the series as it unfolds, make sure you subscribe or follow the show right now. If you enjoyed this pilot, please leave a 5-star rating and share it with a friend. Those small actions help the show to grow and help new listeners discover it. Thank you for listening. I'm Franz Amison, and I'll see you in episode 1 in 2 weeks from today.